Hi, welcome to the It's Your Money and It's Your Estate Spring 2025 workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. This webinar is the 5th session of the It's Your Money 6-week program. The topic of the day is equity and fixed income investing. Our moderator is Peter Kote, and our guest speaker is Mark Hebner. Enjoy the workshop.
Just to kind of summarize where we've been for the past 4 weeks.
Yeah.
We talked a little bit about the financial world being a sales world. We talked a little bit in the past how important it is to understand your net worth, your cash flow, what kind of insurance that you have, all those things you need to know beforehand.
Yep.
The good news is that now we're at the apple rolling off the cart. And I love having you here, Mark, because for two reasons. One, you have you have lots of good experience with the dark side. Talk a little bit about that.
Well, what's the dark side in investing? We like to refer to the dark side as those who think about investing more as a gamble or a casino than they do a way to get a return on their capital. And what we like to say is speculation instead of investing. And so we think of the dark side as people who are just basically gambling in the market. And our goal is to replace that speculation with an education. So that's what I've been doing now for 26 years, Pete.
You're the owner of Index Fund Advisors.
That's correct.
And it's approximately 5 billion in assets, which is actually, I mean, it's a huge number as far as I'm concerned, but it's actually small within the financial services industry.
Well, among those who sell product and sell trading and commissions, but among those who are what we call a fiduciary, registered investment advisors, we're fairly large. CNBC and Barron's rank a bunch of us, and we, I think, ranked number 70 or something in the country, according to CNBC. And according to Barron's, we were in the top 1,200. And I think there's about 50,000 investment advisors out there. So when you only sell advice, it's a little harder to build larger AUMs than that. Although there are some very large AUM firms out there, maybe the largest is in the 400 billion range. But when you talk about, let me just finish that. When you talk about Vanguard or BlackRock, you're talking 11, 12 trillion dollars in assets because they have product. Or Dimensional Fund Advisors is 800 billion, maybe 700 billion, somewhere between there. And so the size of a firm varies a lot by their offering.
How did you get started here? How did you get started with IFA, and why did you do that? Just to go, I think it's really relevant to today's topic.
Sure. Well, first of all, Dimensional Fund Advisors is a firm that we like to recommend for clients, and they just did a new film. It's called Tune Out the Noise, and you can find that by going to ifa.com on our homepage. And in that film, I'm interviewed, and I talk a little bit about how I got into this. But in short, I had a friend of mine who was killed in a car wreck. And after a few years, I heard from the widow, and she asked me to help her with her investments. And I wasn't really doing this business at the time. She just knew me as a relatively successful businessman. And she thought because I knew business, I would understand investing. Well, it's not true. It took me a while to figure that out, but I told her because of your need and because of my own curiosity about my own portfolio, I was going to dig into this. I went to Barnes and Noble down there at Fashion Island. Remember, it used to be next to the Daily Grill down there.
Yes.
Anyway, those are the old days. I came out of there with over 20 books, started combing through them, and realized that this passive investing, index fund investing, was the way to go. Way to go. I started talking to a bunch of my buddies. None of them really understood it. So I created this website, I created a book, we created a film all around this passive investing so we could educate people on the benefits.
I loved your tagline.
Yeah, replacing speculation with an education. That's one. That's for all our videos. My other one is
evidence-based investing.
Evidence-based. I always like to say, I want to change the way the world invests. And the beautiful thing about the web is, in an instant, I can publish to the whole world, and I just love that. And today we have an app that we've invested heavily in, so everybody can get IFA on their phone now. And all of our videos, all our articles, all of our content. We're one of the largest content providers in the world on investing.
Yeah, you got just a wonderful, informative website. How do you charge your clients?
So we charge based on their assets under management, and we have a little fee table. I think we provided it, but it starts at 0.9% for the first $500,000 and then scales down accordingly. And maybe I shouldn't offer this, but we do have discounts. And I think maybe Neil Rudder has some discounted programs for working with some of the people that might learn about us on It's Your Money.
Okay. Talk about some of the services that you do provide through IFA.
Yeah. So we have what I would call a full service, holistic kind of financial planning, wealth management type of business. I have a slide on this. I'll get to it, but we general wealth management, and there's a bunch of elements to that. We also do tax returns. We do financial planning. We have a 2-person financial planning department that work. One of them's a CPA, and they work with clients in developing their financial plan. We help establish pledged asset lines, which is kind of a big deal today because a lot of people have a lot of embedded gains. And if they were to sell those positions to get cash or to get a big amount of money for a house down payment or something, sometimes it's better to borrow today. College planning, Social Security optimization, charitable giving. We help them with their estate planning. We don't do estate planning, but we help them get to a good estate planner. We have a referral network all around the country. And so we help them do all that stuff.
Your office is in Irvine, California.
Yeah.
There's always, do you charge any monies if somebody wants just to come in and take a look-see to see whether or not IFA is a good fit for them?
No, in fact, it's the complete opposite. They get a Bastango lunch when they come in. No. So no, we do a free portfolio review, take a look at their portfolio, maybe just give them a second opinion of what's in their portfolio, what we might recommend and what we might propose to them. We'll do a little risk capacity analysis to determine how much risk is right. And so, no, we don't charge.
And there's no cost and no obligation.
No charge, no obligation.
And let's see, what else would I was going to... I can't think of it right now.
It's all right. Listen, you just hop in there if you got any questions.
Will do.
You've been good at doing that in the past.
Thank you. Let's get going on the on your presentation. So,
all right,
bring it up.
There we go. Let's get rid of those thumbnails. There we go. Everybody see that okay? How many folks do we have today, Pete? Can you tell?
Right now we have approximately just 20 participants. At least that's what I show on the screen.
All right.
But
very good.
We have so if anybody has a Q&A please, feel free to ask the question. And at the end, Eugene will allow you to ask it verbally if we have time.
Good, good.
But right now, let's get into the program.
All right. Well, we have about 40 slides. We're not going to spend a lot of time on every one of them. There's some of them that are my favorites that I'll spend a little more time on, and others we'll kind of skip over. But Pete asked me to talk about the two basic components of investing, which I like to call your risky investments and your safe investments. And that's basically your stocks, or what we call equity, and your bonds, which are often called fixed income. And so we're going to talk about both of those. Do they get copies of these? I think they can get a copy of this
Yes,
somewhere. But
there's our
here's my
outline is completely on the internet. They can download it.
yeah. So there's my bio, a little bit about my history. I was actually a nuclear pharmacist by my first education and my first business. We built that company up, sold it when I was 32. That was another element of me getting into this business. I realized in doing my research for the widow that in my own portfolio, I had done far less than I could have done had I just invested it in the S&P 500 for like 13, 14 years instead of all the stock trading that was being done by my stockbroker I had at the time. So here's our little tagline: replacing speculation with an education. We have about 2,200 clients all over the country because they come to us through our website largely. Our assets under management were 4.9 billion on March 31st. We were back up over 5 billion yesterday, and then today we were down a little bit. It's been moving around quite a bit lately, but it seems to have come back. And so, anyway, that's our office, the Atrium building. Many of you might have been there. I mentioned Bistango. They have the restaurant there right next to us, and it's one of the nice things about working with IFA is we have Bistango come serve us in our conference room, and Pete really loves that, don't you, Pete? Yeah,
Absolutely. It's always a good lunch.
it's always a good lunch. So we talked about our services. Here's our little icons and some of the names. I didn't talk about much on our referrals, but I did say we have estate planning attorneys, we have insurance consultants that work with us, banking, checking, mortgages, trustee services,
By
credit
the way,
cards.
do you receive any kickbacks from these
Oh man,
services?
they pay us like double. Whatever a client gives them, we get twice that amount, Pete. No, no, we have no kickbacks, no fee sharing with
So the
any.
only way you make money is from your clients.
Yeah, I do sell a few Galton boards here and there, Pete. So we have a little device that helps teach people about market randomness. But yes, the and we give those to clients. But our I don't know, 99.9% of our revenue comes from fees that we charge clients. Well, I take that back. We have a small amount of revenue that also comes from our tax services that we provide. We do tax returns for clients. And so that's another element. Any
And
other questions about that?
yes, who's your custodian?
So we work with both Fidelity and Schwab. And so those who aren't familiar with what that means is we don't really hold any individual assets. We're just a provider of advice. And so we go to big, safe firms to hold and custody your assets, it's called. And so you open an account, let's say with Schwab, you make your deposits there, and you agree to have us select investments, manage investments for you, place trades on your behalf, take fees out of your account is one of the things you agree to. And those are the main elements of our agreement that you sign that gives us these rights at Schwab or Fidelity.
And then for an investment vehicle, it of course depends on the client as to what the client wants, but you normally, as a rule, use dimensional funds. Is that correct?
Well, we do, but we have a new little thing we have here on our website. I just want to show you now that you brought that up. And that is what we call our fund options page. And so we've, for a very long time now, had these various options that we provide for clients, and we didn't really push it to the front of our homepage, but we do have it now. And so we stick with what we like to call passive investments. It's, the bright side as opposed to the dark side. And so our favorite fund management firms are Dimensional, Advantis, Vanguard, and BlackRock. And we have what we call factor tilts. So you can get a little more small, a little more value, a little more profitability. These are the factors that explain returns. And then down in the bond area, we have the same thing. Our fixed incomes down here from all of those. And you can do government, you can do tax advantage. We're going to talk about all these here in a little bit.
Okay.
But we have a wide assortment, but we do have a default. And our default is typically a Dimensional small cap value profitability portfolio.
And the reason why you have that as a default?
Well, we like Dimensional for a number of reasons. We're going to talk about some of that, but basically they have custom indexes, the Dimensional indexes that were designed as investment vehicles. Most indexes were really designed as benchmarks, not really for the purpose of investing. And so we really like the research and the academic basis and the evidence-based investing that is espoused and provided into products by dimensional fund advisors.
Okay, let's go to the next slide.
All right. Let's see. There we go. Amen. So clients who hire us, they get to, we're acting as their fiduciary, and I know that's an important part of any of your presentations. In short, a fiduciary acts in the best interest of the client, even if it goes against the interest of the other party, in this case, us. We select and monitor investments of either mutual funds or ETFs. We're using more and more ETFs today. We design portfolios that will match your risk tolerance or your investment objectives. We integrate your existing holdings into your portfolio. Let's say you bring in, 1,000 shares of Apple that you bought 20 years ago, and it's all high capital gain. We wouldn't want to liquidate that and have a big tax penalty, so we'll work that into your portfolio. We consult on tax efficiencies through our financial planning and our CPAs that we have in staff, provide retirement planning services. We also manage 401ks and 403bs for Catholic investing. We do a fair amount of that. We recommend estate services, and we review your overall financial situation.
And by the way, whatever fee-only fiduciary advisor you go to, and I recommend that you at least interview 2 or 3.
Oh, we lost you there. Oop, we can't hear you, Pete. Sorry.
Hey, Mark, I would just continue. He'll either come back or
when he comes back in, yeah. So what Pete was saying is it's good to talk to several different providers of investment advice, and I think that's a great idea. And
because it's a marriage.
Yeah,
you don't want
to. Yeah,
you don't want to jump from one advisor, just like you don't want to jump from one partner to another. It takes time to build that trust.
Yep.
And so you want to make sure that whom you pick, you are going to be with for a 3 to 5 year period minimum.
Exactly.
Stocks, what are they?
Well, stocks are basically where you have a little ownership in some company. It's funny, when I go out and do 401k presentations, I like to explain to the plan participants, the employees of the company, wouldn't it be nice if you actually owned your own company as opposed to just being an employee? Well, that's the beautiful thing about the stock market, is you can become an owner of multiple companies, and you get, as an owner, you get voting rights, and you get rights of distribution of dividends, and you get rights in the gain and the value of those shares. So very important and a wonderful opportunity for individuals all over the world to be a participant, be an owner of all of these companies that are available through these various stock exchanges. There's about 40 stock exchanges around the world that we can access for clients. And so stocks are generally referred to as equity. They have a lot of price fluctuation depending on how you invest, and we're going to talk about that. And the profit sharing has to do with you getting some shares of dividends. Don't get overexcited about dividends, though, because once a dividend is issued, the value and the price of a company declines by the amount of that dividend. This is very confusing for a lot of clients. They're dividend seekers. But real quick, if there's a $100 stock, and they pay a $5 dividend, the next morning it is a rule, a regulatory requirement that the stock opens at $95. So now you have $95 and $5 cash. You're exactly back to where you were. And in a taxable account, you're not there because now you got to pay a tax on that dividend. So dividends are very confusing. There's a couple of papers out there. It's also confusing because the indexes that you see decline with the amount of dividends issued every time companies issue them. So that's a longer story, and I have a petition I've been working on for a year trying to get all the financial media to change the way they report their indexes.
Yeah.
Anyway, there's a lot of ways to purchase stocks. You can buy them individually, which is a really bad idea. You can get them in a mutual fund, which is a good idea. You can get them in an exchange traded fund, which is a little better idea. There's a lot of tax efficiencies. It's really a delay of the taxes. You're not getting out of the taxes, you just delay them. And then there's two broad categories, funds that track an index and those that hire a manager to try to do better than that index by choosing which stocks are to own at certain points in time. So, market capitalization of stocks. So all that means is, are you investing in a very large company, the Magnificent Seven, if you're familiar with those, the Microsofts, Alphabet, Google, Tesla, who else is in there? I can't think of them all right now, but all the NVIDIA, all the big companies are in there. Then there's the mid-cap stocks. And one more thing about those are typically companies that are worth more than $10 billion. Microsoft, Apple was the other one I forgot. And so then there's mid-cap stocks. So this is from 2 billion to 10 billion. And these are rough estimates. They're not perfect. Whoops. I was trying to roll down that screen. And then the last one is a small cap stocks. And those are much smaller. They're basically less than 2 billion. And probably the smallest is in the 200 to 250 million. That's the total value of the company, which is the price per share times all of the shares that are outstanding. And
why is it important to know these terms and why is it important to know what percentage of your portfolio is in these types of stocks?
Well, we're going to show some slides here in a minute, but in essence, the larger the company, the safer they are. Basically, the more diversified by product, by employee, by geography, so they're safer. And because they're safer, they don't have to offer shareholders as high as a return as they would have to if they were a smaller company. And so smaller companies are riskier, and to encourage or entice investors in them, they must offer the prospect or the expectation of getting higher returns. But that comes with greater uncertainty of that return because they're risky. So understanding this sort of spectrum of risk and return is really important for investors.
Yeah. So for those who are watching, it's one of the keys is just like, what do you own at the present time? What percentage of large cap stocks do you have? What percentage of mid cap stocks do you have? What percentage of small cap stocks you have? Because each one, like Mark was saying, has different characteristics and different levels of risk. And you want to understand what kind of portfolio you have so you understand the risk that you're taking.
Yep. So that's an important point. And we're going to talk about your risk capacity in a minute, because that's one of the things we do is we ask you a series of questions to determine how much risk is right for you. And then we have these allocations, as Peter was just referring to, of large, mid, small bonds that have a risk level that matches the answers in your risk capacity survey. So understand bonds. So bonds, the first thing you want to think about is they're a safer instrument, and they're safer because the issuer of the bond is required to give you back the principal or the money you invested at some point in time. Now, if you buy after the bond has been issued, the price is going to fluctuate, and maybe you won't get the same amount of money you put in if you're buying what you might consider the secondary market. That's after the initial offering of the bond. But generally speaking, the bond matures on the date of its maturity. And say it's a 1-year bond, 1 year later, you get your money back. Let's say you put $1,000 in, you get your $1,000 back, and you'll get the interest that the bond issuer agreed to pay you. Now, the default rate, bonds not giving you back your 1,000, is very, very small, and that's because the regulators are really careful about what debt or bonds are able to be issued. And so that's why they're safer and why their returns are less. First thing you want to think about all investing is safety, and your investment means lower returns, and riskiness of your investment means higher, I should always say, expected returns. So the future are always expected. In fact, there's no going in investing. It's one of my pet peeves. You can't say the market's going anywhere. You can only say gone, because from every fair price, which is what the market's designed to do, is to discover fair prices, it's basically an equal 50-50 chance that the next return will be above or below the expected return. So
is the stock market bigger than the bond market?
I just saw that the other day, and can't remember. I don't think it is, actually.
No, the bond market is
They're big.
probably 100 times bigger than the stock market.
Yeah, you know what? I left it in the other room. We just got a book from Dimensional that delineates all of that.
Yeah, it's
But they're two big markets. Yeah.
Yeah, they're huge, the bond market. What is more transparent? Is it easier to buy and sell a stock versus a bond?
Good question. I would say yes, the liquidity of them. We have a number of bonds that we just can't sell. I remember there were some bonds issued by Puerto Rico several years back, and we could not find a buyer for those bonds. So risky bonds, so when their credit rating here is low, it can be very difficult to sometimes sell those. But stocks, as long as you're on major exchanges, are highly liquid, and you can get a bid or an offer to buy your stocks at just about any moment in time.
Would you, I know you don't believe in individual stock purchasing. Is that the same in the bond area?
It is the same, but let me just back up a little bit. We don't rely on beliefs here at IFA. We're focused on evidence. And so, again, one of my other pet peeves, I like to say, take your beliefs to church. It's a good place for them. Here we have data. Now, to a certain degree, no data is 100%, but we can generate what we like to refer to are probabilities of various outcomes. And that's better than taking a belief or some gut feel about investment. In fact, the believing is what really the active investing or individual stock buying is all about. People rely on their gut or on their feel, kind of like betting on a racehorse because of its name or something. A lot of people use their familiarity of a stock as a reason to buy the stock. They work there, they work in the industry, and they think somehow they know more than all the combined knowledge and information that's already priced into those shares.
So what I'm gathering is that the data suggests that you would buy a index bond fund
Or a highly diversified fund.
bond
Exactly.
fund. And just like we had in stocks, the various different capitalizations.
Yeah.
Go through the types of the bonds.
Sure. So you have a wide range of bonds. The U.S. is an issuer of bonds. You've been hearing a lot about that lately as our debt has grown and grown because we keep issuing new ones. But these are among the safest just because our country, the issuer of these, are among the safest in the world. So you have U.S. Treasury bonds here and all varying types of them, from a 30-day bond, a 30-day Treasury bill, we call it, all the way out to a 30-year bond. And the longer you go, the more volatility, the more risk associated with that. And the shorter you go, the safer. And in fact, the 30-day Treasury, U.S. Treasury bond is actually considered zero risk, according to many academics, and generally thought of that way. And all returns are basically adjusted for that risk. Their stock excess returns are considered a return greater than what you could get from a treasury, a 30-day treasury.
So it's important for us to know what the 30-day treasury is when we're investing.
Yes, but it's more important to know what it is over the long haul. And I was just looking at that data yesterday. Over the very long haul, inflation has been about 3%, and the Treasury 30-day Treasury bond, I'm talking since 1926, has paid 3.3%. So it's basically the government's basically saying, if I'm issuing a 30-day bond, I'm basically going to pay you an inflation type of rate for you buying that bond from us. Then you have all kinds of other government related entities, such as Fannie Mae and Ginnie Mae, government-sponsored various what we call agency bonds. There's mortgage-backed securities, corporate bonds. So corporate bonds is also important for you to understand. So Starbucks or Nordstrom's wants to issue a bond rather than sell stock. They will do that. And I always like to use the example of Nordstrom issuing corporate bonds during the COVID closing down of their store. Here they were in deep trouble, no revenue because the stores were all closed. And I remember they issued a bond and they had to offer 15% return on that bond to entice investors to give them money on their corporate bonds. The last one are municipal bonds. And basically, the government allows these issuers to issue them with no tax associated with them, which allows the municipals to offer a lower interest rate in return. So there's no free lunch here. There's no free lunch in any investing. If you think you've outsmarted the market or you're getting something for free, all I can say is you better think again, because everybody, the buyers and the sellers, the issuers, are all considering all the factors. But because municipal bonds have this tax benefit, a California municipal bond for California residents has zero tax involved. They pay a lower rate, and they're of higher risk because it's all in one state, as opposed to diversifying your bonds all over the world, which we like to do. But you can get fairly diversified municipal bonds, short-term, long-term, and various combinations that do make sense for high-income earners in California, New York, and some of these other states that have high tax rates.
Mark, you had mentioned the word diversify a number of times already. Talk a little bit about the importance that you have seen from your data about diversification?
Sure. So famously, diversification is called the only free lunch in investing. And what the free lunch is, it's not that you're getting a higher return from your diversification. What you're doing is you're increasing the probability of getting a certain return through your diversification. So let me see if I can explain this to you. So over the last almost 50 years, these blue little blocks with all these symbols, and here's Walmart, here's the number of symbols that you might recognize, here's Wells Fargo. And so here's what's kind of shocking to a lot of people. Only 175 stocks has survived over the last 49 years on the New York Stock Exchange. Unfortunately, I don't know how many we started with, but it had to be 600, 700. It might have been 1,000 stocks at the beginning of that time period. But many companies go out of business or merge. And so these are the remaining stocks. So it's kind of a good way to think about it. So one of the things I like to do is, here's the range of their risks. Down here is their risk quantified as standard deviation, which is in essence, how much have their returns deviated up or down relative to the average. And what you see here is, if we were to guess, the average stock here has a standard deviation of about 30. So that means they're going all over the place relative to the average return. And that also means you're less likely to get that average because you don't know when you're going to get in and get out. And when there's wide ranges, there's a lot more that can happen versus a more narrow range. Well, when I diversify those investments, you can't really see it, but right under the 90 is the S&P 500 here. But let's just call it a portfolio 90, which is 90% stocks and 10% bonds. You can see it's about the same average return as all of those stocks. Here's your return scale on this side. But the standard deviation is 15. So the essence of diversification is you have the same expected return, but less risk of obtaining it. And that's a difficult thing for people to understand, but this chart, I think, helps people understand why diversify. And thank you for that great question, Pete.
Well, it's almost like a number 2 rule in investing. Diversify, diversify, diversify. It's kind of
like real estate.
Yeah. It's,
get your location.
Yeah.
Yeah.
And there's no secret sauce.
Nope. It has to do with nobody knows which one's going to be the winner. That's the other element, because they're all fairly priced. And that's a tough concept. Eugene Fama, the inventor of what's known as the efficient market hypothesis, which we're going to talk about somewhere, he's gone beyond calling them fair prices. He's just saying everything's priced right. And that's really important that you realize, is that the price of all these securities are just right. They're not too high, they're not too low. And the goal of the active investor, the speculator, the gambler, is to try to identify stocks or any kind of investment, a whole index, that's overvalued or undervalued. And the punchline here is there aren't any. They're all priced just right. And so that moves you to another kind of method, another kind of investment strategy, which is focusing on your risk as opposed to looking for or seeking mispriced securities, because there aren't any. Now, your active investors would love to come argue with me about that, but I got the data. All they got is beliefs. Okay. All right. So what does that mean?
What is the risk capacity survey?
Yeah. So what I just laid out to you is what's really important is how much risk you take. So you better have a good way to figure that out. Well, we have a survey where we look at 5 dimensions of your risk capacity to try to arrive at a stock bond mix, safe investments, risky investments, that we think are appropriate for you, given your time horizon, given your net worth, your net income, given your ability to withstand losses, and given your understanding of investing and risk and return. And so all of these elements are crucial for investors in determining how much risk is right for you. And this is probably the single most important exercise for investors, is getting to that right risk level. You talked earlier about marriage between an investment advisor and a client, somebody you can stick with and you're comfortable with. It's the same thing here. This is like a marriage between the investor and the investment. You want a portfolio that you're comfortable with, and you can stick out, you can ride and stick out all the problems that you experience along the way, which are mostly losses that you incur.
Yeah, we're highly emotional when it comes to investing. Can anyone take that survey? Do you have to be a client of IFA in order to take that survey?
Nope, just hop over to ifa.com. It's right on the top of the website. It says risk capacity survey.
Okay. And just to let you know, on the screen, we have the side, if you want to just remove that, and so that we have the full. This is probably, yeah, there you. This is probably the active versus the passive investing.
Yes, it is. But I'm just going to.
Oh, you're going to kind of show us the survey?
Well, I'm going to try. We had our website down this morning. We've been working on. Oh, there we go. So here's you can figure out what your time horizon is. We basically ask, when do you need 20% of your money? And let's say you've got 15 years, your net worth is 250,000, your income, let's say 150,000. Your ability to withstand losses, how much of a 12-month loss would you sit through? And let's say it's 30%. And then the last one is your knowledge about investing. And we just talked about this risk return chart. And then we just say, well, where are you? And you say, maybe I'm average, right? So then you fill in this information, you give us your investing goals and objectives, and you click here and you get a score between 1 and 100.
I love those kinds of surveys.
Yeah, they're really important. In fact, we're working on like 5 new surveys right now to help investors do a number of different, make a number of important choices. I had also mentioned, here's our awards, various rankings. Here's links to various portfolios. And here's this movie I would urge all of you to watch. It's called Tune Out the Noise, which basically forget about watching all of this craziness of the markets going up and down and focus on your risk instead. This has, I think, 3 Nobel laureates, a bunch of billionaires who founded Dimensional Fund Advisors, and there's 2 individuals who were not part of their firm. One was me, and one was another advisor, who kind of give our version of passive investing and why it's important. Okay, any more on that?
Nope. Let's talk a little bit about active versus passive, because there is in the world of investment, you need to know upfront when you meet with a financial advisor, are they active or are they passive? And what does that mean?
So I gave you a little explanation a few minutes ago. The primary difference is the passive investor accepts the evidence, and there's an overwhelming amount of evidence that prices are right. The active investor has this misconception or belief that they can find securities that are undervalued and load up on them and wait till they catch up to the fair market price or the right price, and then they'll make more return. And then they also are watching for other securities they bought, which all of a sudden became overvalued, and now it's time to get out of those. First of all, there's in a taxable account, that's a big no-no, because you're having to sell and generate capital gains when you have a capital gain. And there's a lot more expenses involved. First of all, you have to pay this individual who thinks they know more than the market. And then there's these taxes involved. So it's a more expensive type of investment strategy. than the passive investment strategy. And it's more concentrated, which means, as I just showed you in those individual stocks, each stock has a risk of 30, where the passive investment, which is typically 10,000 stocks all at once, might have a risk of 15. And so you basically double the chance of capturing your expected return by owning a large diversified portfolio, as opposed to gambling and speculating on which ones are mispriced when there aren't any.
I listen to Warren Buffett a lot, and he recommends passive investing for the general public.
Yeah.
However, he is an active manager himself.
He is. I wonder how he's been doing at that. If we look here over the last 22 years, Warren Buffett has just barely beat a index that's appropriate for him, which is a large value index, only 0.65, but he's had a huge standard deviation of that excess return. And you can see that in these bars. This is his return relative to the index, -14, -7, -5. Then he gets 3 negatives, then 3 positive, then a big negative, then a little positive. And you can see there is a very high inconsistency of his return above the benchmark. Most people are enthralled with Warren Buffett because the 22 years prior to the last 22 years, his whole record goes back 44 years. Here, he was shooting the lights out, earning 16% per year over the benchmark. So you would think that was an indication of skill, but what this tells you, it was only luck. Sorry, Warren. He's got some great philosophy, which has to do with his overall track record, which he doesn't like to trade a lot. He doesn't like to buy expensive stocks relative to what an accountant says a company's worth. That doesn't mean it's not priced right, but it can be expensive relative companies that are close to what an accountant says it's worth. Anyway, so Warren Buffett, I think, is pretty aware of this, and this has led him to recommending an index fund. You could have bought a large value index fund over this period and earned about the same return as what Warren and his investment managers earned at these companies. If you think about it, he's almost running a mutual fund with all of these companies that he has in here. And so it's not really your typical mutual fund manager. And his...
How many active managers have you done this kind of analysis on?
Well, we do them on, I don't know, thousands of them. We're constantly monitoring various active management firms.
Is that on your website, or is that we'd have to talk to you about that?
It's all on our website.
Okay.
And
great.
now I'm just noticing that our website is having problems this morning. It's like it's down right now again. Anyway, we look at the 20-year track record. Every year we pull up the funds that existed 20 years ago and what has happened to them up till today. And one of the most shocking things for most people is that about 60% of those fund companies go out of business, or they're merged with other funds because they have poor performance. And this is really confusing to people when they're looking at mutual fund performance, because they do not consider the fact that more than half of them went out of business over a 20-year period, which is a great reminder that there's basically they're just lucky. And there's a way to look at the luck versus the skill of these investors, and we basically see no evidence of people being skillful. But we do see a lot of managers, maybe 20% of managers, who got lucky over their stock picks over time and ended up doing better than a benchmark. But then, as I'm going to show you in just a second, that luck does not persist.
Let's go to the next slide.
Yeah. Let's see, where was I? So here, where was a passive. So here are some of the underlying principles for the passive investor. So financial markets are efficient. What does that mean? Well, um, prices basically reflect all the available information in the world, and the stock exchanges of the world provide a very efficient way to bring that knowledge and information and forecasts of about 10 million investors a day, 10 million investors a day, and embed that into the price. And that's why the price is right. It's a very efficient way to convert knowledge, information, forecasts into a price. And because of that, when prices are right, your returns are dependent on your risk. They're not tied to your speculation. And that risk and the return are inseparable, and why the risk capacity survey is so important. We talked about the benefits of diversification. The structure has to do with small, mid, large, government bonds, corporate bonds. Basically, these are structures around what we call factors. And then because this is not so easy to understand and to do everything correct going forward, there is an advantage in working with what we call a passive advisor going forward. So we call this evidence-based investing, and I alluded to this chart a little bit earlier, but I just want to spend just a moment because this is one of my favorite charts to remind people about the lack of skill among stock picking managers. So this is a great study that looked at what we call the persistence of outperformance of actively managed funds. And in this study, Standard & Poor's down here, they did this study. They looked at 2 3-year periods. The first 3 years, they sorted out the wheat from the chaff by finding the managers who beat their benchmarks in the first 3-year period. Then they track those so-called winners, which were really just lucky managers, to see how they did in the next 3 years. And take a look at this for large cap funds. These are mutual funds that are compared to the S&P 500. In the first 3-year period in this study, only 10.5% or 99 out of 938 managers did better than their benchmark. Now, right off the bat, that should give you pause. There's a 90% chance you're better off in the index fund right from the very beginning. But a lot of our industry will go back the last 3 years when they're trying to find a fund for you today and say, oh, who are the winners? Let's buy one of those for you and we'll put you in that. Well, what happened for the next 3 years? When we should have a little pop-up quiz, see who understands this, Pete, but you follow those 99 managers, 0 of them continued to win over the next 3 years. So there was a 0 chance of you finding a manager based on the last 3-year return that would give you excess return above their benchmark going forward, which is why you're better off just to buy an index fund and forget about the whole manager selection game. And we see this in small caps. In small caps, we have a little bit of excess return or repeat. 4 out of the original 524 funds continued to earn a excess return in the second period, but that's the only one. In international funds, 0% repeated their winning performance. Large values, 0 repeated. Small cap values, 0 repeated. And emerging markets, 0 repeated. Are there any questions about that? Pete, you got any questions about that?
It's the evidence, it's there.
You don't have to believe anything, Pete.
Exactly.
So this is another one that basically looked at this luck versus skill idea. That's the conclusion in the last slide, is that basically these managers got lucky. And here we see all across the board, just in short, out of 613 mutual funds, 99.7% of them over 20 years underperformed the benchmark, and only 0.3 did better. And those are just what I like to call the really lucky managers.
So we go index.
Yeah.
We go index funds. What is, I'm not sure if you have a slide on this, but what is asset allocation?
Yeah. So we're going to get to asset allocation. Yeah. So let me just cover market timing,
Sure.
which is another element, because in broad strokes, active investing can be broken down into two strategies: stock picking and market timing. I mean, if you think about it, even stock picking, you're trying to time individual stocks, and that doesn't work.
You
And a
mean
market type,
you don't think I can pick out the next Apple or the next Tesla or
yeah,
it's the
well,
dream.
it's a dream, but what I just showed you in those slides is the answer is no.
Yeah, dang. You
Now,
really burst my bubble, Mark.
yeah, we burst a lot of bubbles in that respect, unfortunately, for the active investing world. Uh, and what Jack Bogle liked to say that hope springs eternal,
Yes.
and the gambling instinct will never go away. After people hear this, they almost always ask, well, what happens if everybody buys index funds? And what I tell them is when they decide to dynamite all of the casinos in Las Vegas because there's no more gamblers, then we can worry about the fact that everybody basically went to an index strategy. It's not going to happen.
What is this particular slide
So
telling
this
us?
is the market timing slide we like to remind people of. So in this study, we looked at 20 years of the returns of the S&P. That's actually 5,051 days over this 20-year period. And what we wanted to know is how concentrated were the returns in individual days, okay? And one way to look at that is, let's say I started off with $1,000 at the beginning of that period, and I just left it there. I didn't do anything. 20 years later, it was worth $8,531. Now, what happens if I took the 10 biggest return, the 5 biggest return days out of 20 years, out of this 5,051 days? Your return drops all the way down to 5,300. And let's just get to the punchline. What if you missed 40 days? That's 2 days a year over the last 20 years. Your $1,000 was only worth $1,063. Now, a lot of criticism of this because nobody's going to miss just those exact specific days. But the whole point of it, and I can tell you because I've been investing over this 20 years, we started in 1999. There were some days in there where you had a 10% return. And if you didn't get that, then you missed out on a big chunk of the total return over that period. Then there's a lot of days in there where 2 and 3% days. And if you think about it, the annualized return you can see down here is about 11% a year. If you missed a bunch of those 2 or 3% days because you were nervous or out of the market, you could easily miss the entire return for the full year. So that's a good lesson in trying not to time the market. And we just went through this when the announcement came out about the tariffs. The market took a drop. I don't know, what was it, 15% or something. And a lot of people freaked out. They wanted to get out. We said, no, the market will come back. Boom, it's already back to where it was.
And market timing is just a huge business. Billions.
Huge. That newsletters all over the place.
It's just because buying and selling is what makes Wall Street money.
That's right. So I didn't realize I actually had this Warren Buffett slide in here. And so we don't need to go over it again. No. Everybody can look at it. This is the market response to a crisis. And basically what we just said, the markets always come back. The reason the markets come back, by the way, is they're already always resetting the price to a fair price. What's fair? What's fair both to the seller and to the buyer. And when it's fair, it's always being reset to the same expected return that's relative to the risk of the investment. And that's why we see over and over again, this is 5 years after a certain crisis, we see in 5-year periods after the crisis, the market return is actually pretty close to the long-term average of returns. So
the market works really well. I compare it, a lot of it, to real estate.
Yeah.
Tell me what a value of a particular home is, or apartment building, or whatever. And my response is, we don't know the value until we put it on the market.
And we find a buyer. Exactly.
Yes. Yeah. Until there's a buyer, you don't have an actual market value.
Yeah.
And so the stock market works exactly the same way. I mean, you got a buyer and seller. This is what they believe to be the value of that stock.
And I'll add to that, Pete, when you find a buyer for your building, that's one transaction between two people, right? Typically, in any one day, there are about 5 million buyers and about 5 million sellers of probably, most of that's probably among, I don't know, 3,000 stocks or something like that. So there is so many opportunities to find the fair market value, which is what you're referring to in a piece of property, for any security on the planet. And that's in essence what's going on. And I also like to add to your analogy the idea of an appraisal. And most people think about those appraisals in terms of your home. And unfortunately, most of them are tied to a bank loan. But the appraiser's job is to find at least 3 other sales that were similar to your sale, and then uses appraisal manual to look at the pluses and minuses of various properties to try to come up with the fair market value for your property. Well, in the stock market, we don't have to worry about that because there's so many buyers and so many sellers. And that is the whole idea of the efficient market hypothesis, is this efficiency of having 10 million traders taking all of their information and knowledge, which is going on in a building sale. The seller has some information, the buyer has some information. They bring that to the table and they finally arrive at a price.
Right.
Okay. Any more on that?
Nope.
Okay, so here's one way to think about one of the first things we discussed were small cap stocks. We don't have a button on here for mid cap. Large cap stocks are here like the total US market or the S&P 500. And here you can see these differences of risk between a small cap almost at a 20 risk and a large cap down here at about a 14 or a 15 risk. Well, we also see a little more return. And when we add the value component, we didn't really talk about value versus growth. We should add that to that other slide. We just talk about size and not value. But here's the S&P, or here's a large growth asset. And here's the opposite of that, small value. And we see here large growth at about a 17 risk and about a return of about 12 in this 75-year period. But here's small value, the opposite of large growth. The risk goes up to about 18 and the return historically is closer to 14 and a half. Now, this higher standard deviation means there's a lower probability you're going to capture that average return because of all the wild swings or the deviation from the average. But this shows you a bunch of individual asset classes or indexes. We call them the IFA indexes here, over a 75-year period. And then we combine those in an asset allocation that you referred to, Pete. And here's 100% stock combination. And these square ones we leave out because they have lots of risk and low returns. But in this portfolio 100, we have all these round icons here, and we allocate those out in various percentages and position you at a risk of around 16, which we think is a little bit of a sweet spot in terms of somebody who's capable of handling a full equity portfolio. And one of the reasons is at this risk level, in a really bad market, the worst we've seen over a 12-month period is about half loss of your portfolio. And for any of you been in a divorce, you understand what half means. It's not good. Anyway, we can see portfolio 100 here at about 12.8% return. And here's the S&P just as a comparison at about 11 point something. And this actually has a 0.9 fee deduction. So it's really more than that if you're looking at just the indexes versus the
There
S&P.
is not one type of investment in the stock market. You want to be diversified.
You want to be diversified.
Area. But how does the bond market fit into your asset allocation?
So remember I told you bonds are safe, stocks are risky. That's the title of my talk about stocks and bonds. So here are a bunch of bond funds, and the safest of the bond fund down here in the corner are bond funds that last about a year. They mature, you get your money back a year later, so it's pretty safe. Look at that standard deviation. It's about 1.8 over 75 years, and the return is commensurate with a low risk of about 4.5%. And if I stretch that out, you can't really see the button, but these are 5-year bonds. Well, what do the 5 years do? It pushes up your risk to about 4, and it pushes up your return here to maybe 5.3. And so basically, they act as what I like to call a rudder in a sailboat. That's a good one for Neil, by the way, for Neil Rudder. Have a little safety involved on your investments. Anyway, so it provides a little ballast or a rudder at the bottom of the sailboat to stop the sway back and forth so much by reducing basically the risk. Though down here is a 60-40 portfolio, 60% stocks, 40% fixed income. And now you see we bring the risk down below 10 and the return is about 10. So right there in the middle, you kind of get a 1-for-1 for every unit of risk. The return has been about equal unit of return.
Which, according to all the studies, your asset allocation is the number one driver of your return.
Well, Pete, this could show you that as clear as a bell, because here's your riskiest asset allocation, and you can see the return has been, let's say, 12 or 12.8 maybe. And as we reduce that risk, historically speaking, over 75 years, that's not a small sample size, you can see a reduction in that return. And so, by the way, this chart earned a Nobel Prize for Harry Markowitz, who used to consult with us. He's passed away. And he put this in a paper that he published in 1952. And in 1990, they finally gave him a Nobel Prize for it. But that was the same year I was born, Pete, and that's why it's my destiny to bring this to the world. All right.
I love the passion.
Okay.
But each one of us should know our asset allocation.
That's right. You know, it's always surprising when people don't know it. When I ask them, Pete, go ahead.
No, nobody. It's kind of like people don't know their own net worth. They don't understand their own cash flow.
Yeah, so, that's why you got to do those financial plans. Yep.
Yeah. So the other thing is that if we learn anything from this session, asset allocation is really important. Index funds are really important. Is there only one type of index fund? Are all index funds the same?
So let me rephrase your question. Are all indexes the same?
Okay.
And that's the focus of this particular slide. So I'm just using these two companies as an example and one of the reasons we like Dimensional, but there are many other examples of these. So Dimensional has their own indexes, and they're different from the indexes that Vanguard uses. But if you look at the prospectus or their Morningstar categorization, you'll see they're both, in this case, two small value funds. Burgundy is Vanguard, blue is Dimensional Fund Advisors. And on first blush, you want to look at the expense ratio. This is what most people do. And here we see Dimensional at 0.31. That's an annual percentage of your amount of assets that you have with them and the fee that they will charge. But look at Vanguard, it's 0.07. So most people say, well, gosh, give me that lower fee fund because they're both small value. Well, when I first discovered this, I decided to name my firm Index Fund Advisors because so few people understand the differences in indexes, Pete. So let's look at the size element. We talked about large, small, mid-cap. Here, just two small funds. At Dimensional, the average small size is 3.5 billion. But over here at Vanguard, it's 7.3 billion. Look at that. More than double the average market capitalization company. So now we realize that small is not just an adjective, we can get a number. Science, evidence, this is all what we're about, data. And so what we've also seen, and I just showed you in the previous chart, the smaller the company, the higher the returns have been. over 97 years. This is just the last 25 years. And you can see that if we put $10,000 in it back in year 2000, which is about when I started, you can see that here at Dimensional that grew to 118,000. Of course, no taxes, no transactions, and all that stuff, just to buy and hold, look at their return. Where at Vanguard, it was 103,000. And so it really pays for investors to dig deep and understand the index that these funds are designed to track. So that's a small, and value. Value is a little more complicated, but this is only 0.5, this is 0.8. They only go up to about 1 or 1.2 at the extreme. And so basically you want a higher number in the value metric, and you can see this is 30% higher. So a lot more value, what we call tilt, to the dimensional portfolio versus the Vanguard. And the combination of those two really makes these gaps in returns. If we take value out, we just look at size. Now we see these two numbers are close to each other, where here they're very different because this is not a value tilted fund. Size is still 4 versus 6.5. And again, we see 90,000 versus 80,000. Now, as a check to see if that's what's really going on, let's look at two large blend funds, one from Dimensional, one from Vanguard. Fees are similar. The value exposure is the same. The size exposure is similar. It's usually, those are right on. It looks like they've changed a little bit lately. And we see the returns are now the same, very similar. In fact, maybe just because this fee is 4 basis points higher, you're going to end up with a little bit different. And actually, because of this, we don't use this Dimensional large blend fund. We go to Vanguard or Schwab because Schwab, I think, just dropped theirs. I think I saw one the other day. It was at 2.02, but it used to be 0.03. Was among the cheapest of those funds. And so this is an S&P 500 type index, and Dimensional actually has, and it's the only one where they use what we call a third-party index, all of their other funds, and you can see dramatic differences here in these international markets. So you got to dig deep to fully appreciate the differences in the index construction rules, Pete, and why this isn't just, go buy me the S&P 500 and I'm done, or go buy everything over at Vanguard in the same small value or small cap allocation that I saw over at IFA. You want to have a deep understanding of the differences of all of these index constructions.
Does the Dimensional funds, when you do the large cap growth value, mimic the S&P 500?
Only in the large blend, not the large value or the large growth. In fact, here you can see large value. You have more value in it, 0.44 versus 0.38, and you have a smaller size. Their large is smaller, 85 versus 115 billion. And you can see a pretty substantial difference here over this whole period. 1,000 grew to 77,000 versus 60,000.
Okay. One of the things that that I would just want to make clear is that for those individuals who are invested in Vanguard funds,
yeah,
are you suggesting that they should make a change, or how should they view this?
So here's the problem. If they have invested in those Vanguard funds a long time ago and they have a large capital gain in a taxable account, I think they ought to think long and hard about paying a lot of taxes to make the switch, okay? But if they hold those Vanguard funds in an IRA or some tax-deferred account, then I do think it is a good idea for them to switch to a better index. As I showed you in the beginning, there's Advantis. Advantis has similar funds to Dimensional. BlackRock has some more small and value tilted funds. And so it requires a in-depth analysis and then a continually monitoring of these. We update this chart I think this is year end. I don't remember if this is updated every month. I think it is now. And so we monitor the changes, and even Vanguard over the years, I would guess in this small cap and small value fund, I bet they had 3 different indexes that they tracked over time in that particular fund. They changed them. The last one is tied to the University of Chicago's Center for Research and Security Prices, but they used, they could there's a S&P 600, which is a small cap. There's a Russell 2000, which is a small cap. And so this is one of the first things that was, once I figured out passive was good, then I hit upon this discovery that there were so many differences among indexes that had the same name, Pete. And so this is one of the really most important slides. So many good ones that we're talking about today, but this is really important that people understand that just because it's called a small cap, it doesn't mean it's the same as another index provider of small cap funds.
By the way, there's probably around 20,000 mutual funds in the United States today, probably more in the world, and you can't go by the name. You just
That's right.
Gotta dig a little bit deeper, or quite a bit deeper, to actually see what's going on. And most of your active funds are churning, and churning is a term where they buying and selling throughout the year. And boy, you talk about tax inefficiency, it's just a killer. And the thing of it is that these active funds are in the majority. Most people, this is what they buy.
Yeah.
And so if you're in a Vanguard, you're better off than most. At least you're in the index fund. You got low fees. And just, make sure your asset allocation is good. And you can get the dimensional funds. Explain the difference between an index fund and an ETF.
So ETFs are index funds. So exchange traded funds and mutual funds, the one's mutual and one's exchange traded. That's a better way to think about it. And either one of them can track an index. They're basically wrappers around some kind of an investment strategy. And the primary difference between the mutual fund and the ETF is the ETF is not required to distribute capital gains that are generated throughout the year due to its trading. You delay the payment of capital gains until you sell that ETF. And so that is one of the key advantages, is there's a delay in the tax liability. The mutual fund distribution in an ETF is accumulated in the ETF, and so the capital gain grows. In the mutual fund, because those capital gains are distributed every year, they reduce now the amount of capital gain in the fund and the price when they distribute those. And so there's less of a tax burden when you sell the mutual fund because you've been paying along the way.
Should we be concerned about the type of government, whether we have a Republican, whether we have a MAGA, whether we have a Democrat in office, as to how we should be investing?
No. And that all has to do with the fair price. And let me see if this is back up and running here. Hey, we got it. When we go back over history, and let me see if I can get my eyes on this chart real quick. Bingo. When we look at history, when the Republicans were in charge, and there was only 13 years of that where they were in charge of the House, the Senate, and the presidency, the returns were 14.5%. And when the Democrats were in charge, it was 14%. I wouldn't worry about the 0.5 here. Basically, there are many other factors that impact returns for investors. And so whoever's in charge, the actions or even the forecasts relative to the Republican or Democrat being in charge are already embedded in the price. And so the price is right means they've already considered that they're Republican or they're Democrats and have discounted that in terms of the overall market opinion, since the beginning of the year, I've often said, well, the Democrats are selling and the Republicans are buying. But if you think about it, it's a pretty even split across the country. And so that gives us a market. And I think many on each side with their investments are only concerned about their return and not necessarily the government. There are people who make their stance and their investments based on their political persuasion. But what I would tell you is it doesn't matter. And we see this over and over. It's based. So let's say you're a Republican right now and you think what Trump is doing is such as a great idea. That is already priced in. It's already adjusting. And what we like to say about market randomness is it's surprises that make the market move. That's a surprise above and beyond what's already been forecasted and embedded in the price. And it could go the same side with the Democrats. If they think there's negative things going on, they've forecasted those negative things. And then they might get a surprise and maybe things are worse or better than what it was forecasted. And that causes changes in prices.
We have a question regarding I-bonds. Are they a good investment for grandchildren?
I don't really know if that's a big deal. I prefer diversification among bonds and that they spread them out over 1 year, 2 year, 3 year, 5 year. You don't really need to go much beyond the 5 year bond.
I would probably recommend a blend of small cap stocks for a grandchild, just because hopefully you can keep it in the market for 18, 20 years.
So it depends on what their objective are. If that's for a college fund, even if it's a college fund, at such a young age, you want to put them in a full equity portfolio, and then over time reduce this risk to maybe a 25 or a 30 when it gets time to take money out to go to college. So one thing I would urge them to do is take the risk capacity survey. It'll help get to a risk level that's appropriate given the objective and the goals for those particular funds.
Mark, we have about 5 minutes left.
Okay.
And I know we didn't go through every one of your slides, but they're available. Do you want to kind of go through your slides to see which ones you kind of want to point out before we have to sign off?
Yep. So here's one I want everybody to look at. Page 32 on your presentation. It just shows the difference between these various characteristics of companies. Remember, we started off with large cap and small cap. The difference over long periods of time are about 2% a year in the U.S., 3.8% international, and 1.3% in the emerging markets. The value differences, profitability is another factor, investments another factor. These are the things that portfolios should be constructed around in terms of designing asset allocation, and it should not be tied to speculation. Another important thing to remember is in short periods of time, we don't expect value to beat growth every year. And in fact, when we look historically, in 1 year periods, value has only done better than growth about 60% of the 1 year period. So at least 40% of the time, you're not going to get what you expected. But the longer you hold that, 20 years out, for example, it's about 95% of the time that value has done better than growth. And the same thing applies to small and profitability and even the stock market versus the T-bills. You don't see this every year. And as we go around the world, we see the same thing. Here's international markets and here's emerging markets. There's various probabilities of time. Real quick, some of the benefits of working with an advisor is the more disciplined you are, the more you follow the advice of the expert, the more likely you'll capture the return of the asset allocation that you were assigned at the end of your risk capacity survey. If you don't follow the advice, you get in there and try to time the market and move in and out of different risk levels. Our record of our client study of 533 clients discovered you'd only get about 78%, historically anyway, of our clients didn't really capture the full returns of the portfolio they were given. Now, we talked about asset allocation. You asked about this earlier, Pete. Here's an example of an allocation of stocks. We use large cap value, small cap value, REITs, and then in the international space, there's a value, a small and a small value. In emerging markets, you've got a blend, a value and a small. These are all dimensional funds and the indexes, and then you get some nice safe bonds there. When you're all done, you have 13,000 companies, what I like to call an investment in capitalism incorporated. And then the beauty of having this historic return is we can now look at data every month going back to 1928 here and see lots of information and data about the historical risk and return. Here's every year up and down and the growth of a dollar over that period. And I'm done.
That's one of those sudden surprises. Question, and I think this is an excellent question because it's a number crunching exercise.
All right.
One is I'm 65,
Yep.
lower income around $13,000 annually on investments,
Yeah.
not using to live on.
Okay.
Should I be using my taxable or IRA savings now for yearly income until I take Social Security at age 73?
So
You got to run the numbers.
yeah, the best thing is to do a full financial plan.
Yes.
And so we have software that is called a Right Capital or eMoney, and we have a financial planning department. And you need to look at the overall situation. But just generally speaking, when we're doing withdrawals for clients, and we have a lot of clients we send a monthly check to for their living expenses, the order of the withdrawals, if we start with the taxable account and spend down that account, this allows the tax deferral of a traditional IRA to get more benefit. And then the last account we spend money out of is a Roth, if you have a Roth IRA, because that has no tax until you spend the money, and when you spend it, there's no tax either. So it's taxable, traditional IRA, Roth IRA, in that order. But the best thing is, it's really hard to answer that question with just a few data points, is to run a full financial plan for you. And we're even doing these complimentary now to teach prospective clients a little bit of the process of what's involved in a financial plan. Then that's something new, Pete. We'll actually do I would say sort of a broad level financial plan for somebody as in a process of trying to show them the benefits of working with an advisor. And also it gives us a little better understanding of the client and whether they'll be a good fit for us.
Yeah, it's a good financial advisor is one who can crunch the numbers for you.
Yeah,
it's just one of the keys. And as you could see, Mark, you have crunched a lot of numbers.
I've been crunching numbers for 26 years, Pete.
Exactly. You are a number cruncher.